Hello and Namaste, this is Neeraj here once again and welcome back to my channel Financial Market Analysis Twist by Neeraj Shah. So in today's video, I would like to discuss regarding the rising inflation and rising bond yields and its impact on the banking and auto stocks in general in the market. So before starting this video, I would just request all of you, if you have not yet subscribed to my channel, you please subscribe and put a like button if you please like this video, so that YouTube promotes it and maximum people can benefit from it. And also I have a separate format where on the personalized basis, if somebody wants to consult, take my consultancy regarding the stocks and investments and different assets and business consultancy, it's on a nominal chargeable basis. My email details are in the description box down below. You can send me mail and we can set up the meeting. And also a disclaimer before starting this video is that all the views expressed here in this video are based on the data available and the analysis of those data, my analysis of those data, and viewers are requested to do their own due diligence and research before acting on this advice, as I am nowhere responsible for their profits or losses, investment decisions basically. So let's start. As you know that in the recent times the inflation is rising, and the rise in inflation has a very negative effect on everything. So I just wanted to show you that how the bond yields are also rising in proportion to this increasing inflation. And even though the RBI has not acted in timely manner in increasing the interest rates and resetting the interest rates, but how automatically it is going to happen and how it is going to impact the banking and auto stocks. So I'll just share you with the screen regarding this 10-year Indian government bond. Okay, 10-year bond yields of the government. 1 second, please bear with me. You see, as you can see, that this was the bottom was made in somewhere in June 2021. You see, this was the bottom in February 2021, and after that it had, this was the bottom. And at the peak of the bond yield, 10-year Indian government bond yield, was in September 2018, when it had reached 8.1229%. So as you can see, that full cycle, and because I think if I remember correctly, it was the time, this is the time when the market, when the RBI had started reducing the rates, and that's how the bond yields also, and how this reduction in rate and the high growth rate had percolated with the low inflation. So this is that era of low inflation and the low interest rates, and that is how that bond yields were going down. And now you can see that era of, it's already bottomed in 2021 in February and February to May, and from that time it has started slowly inching up onwards, as you can get the full cycle. So I see that it will only stop at 8%, or even maybe it will again touch that high of 8.1217%. So this is what I wanted to share with you. You can see that in the chart, that how it is going. It is on its way up only. So what is this actually, as I keep on telling in all my videos, in generally, if you have seen that even if the RBI doesn't do, there are automatic ways of adjusting as per the inflation, and where the rupee will go down, depreciation of rupee will happen against dollar, and the bond yields will keep on rising. So that way also RBI will be behind the curve. So now also, if RBI, anyway, there are expectations, that's why bond yield is rising, because expectations that now I think in this week RBI is meeting from today for 2-3 days, and they will decide regarding the interest rates, and there are expectations that at least 35 basis points, 40 basis points, that the interest rates will be high. So whether that hike happens or more hike happens in the interest rate, it's not the question here. The question is that anyway it will be reflected in the rising bond yields, and this will, what it will do to the banking stock is that most of the banks have that in their investment, in their portfolio, which is mark to mark basis, that held to maturities. So because of the rising bond yields, you are going to see that price of those, most of the bonds will come down, and that is why they have to book the losses in the M2M category, mark to market basis. So that is where you will see, because if you see from this point of 7.5%, which I see that it can go easily up to, the bond yields can go up to 8% easily, that is around 7.5% of the rise in the bond yield. So proportionately, because price and bond yields are inversely proportional. So if the rising bond yields, then the price of the bonds will come down also proportionately. I mean, there is no exact proportionately, but it is inverse proportional, means around 7-10%. Even the price decline in the bond prices you will see, and that is where the most of the banks holding these bonds, because all the Indian banks would be holding this as a percentage of that. That is not that is a separate issue, but you will see a sharp decline in most of these provisions. I'm sorry, they will have to make the mark to market basis losses. They have to book the provisional losses into the balance sheet, into that report the next quarter. Means what you will see now, it's in the June quarter, you will see maximum of these banks will have that losses of mark to market losses in that investment. That's why they are also you will see that correction in the stock price, because definitely the bond prices will be down by 10%, 7 to 10%, if what my theory or my thesis about this rising bond yields is one correct. So in that case, you will see the bond prices also going down, and that's where most of the banks will have to book mark to market losses, MTM losses, what we call, because there are bonds held to maturity. So that is where they need to book those losses, and so the banking stocks I see negative, and because of the rising bond yields and also expectation that the RBI is anyway behind the curve, and they will be forced to take much more interest rate hikes than in the normal case they would have taken, or even if they don't take, then the higher inflation will force them to do some adjustments in other ways, so that liquidity is sucked from the market, interest rate goes up indirectly. Already the deposit loan lending rates of the banks have gone up by 20 basis points in most of the cases in India, and with this rising bond yields, you will see the more lending rates going up more. So that is where also the auto stocks, because most of these auto or two-wheeler, four-wheelers are taken on are purchased on the loan basis, EMI basis. So that is where also the impact is going to increase in the higher EMI, and that is what it is going to impact the auto sales also. With this, all this kind of a negative scenario world over, this conflict and this kind of a, where this rising fuel prices also is impacting, is going to impact the sales of auto, and this rising bond yields. So I think auto sector is also very negative. So these are the two sectors which as of now I believe that banking and auto stocks looks to be negative, and you have to take a decision, because I don't see any chance of it going up in the near to medium term basis. They are going to be in a declining phase. As I told you, it's a negative. These are in the negative territories. So that's it. I just wanted to share my thoughts regarding this, and we'll see you once again with some unique other concept and ideas, and regarding whatever, if I understand. Till that time, ciao from Neeraj from Moscow, and love you all. See you.